Okay, so what we're looking at, ooh, let's zoom out for a second. So that's the wrong term too. Okay, so this is the 20-year Treasury bond. This is essentially what we've been pricing most mortgage rates off as far as what direction they're going to go. It's a really good indicator as far as what direction rates will go. So here's kind of how we do it essentially. The easiest way, let me clear all this off for a quick second. Let's go. Let's go week. Make it nice and small. Okay. So basically, here's how any financial chart works. It doesn't matter whether it's this one or if it's a stock or, well, it does matter. But my point is that at the end of the day, the reality is that if you can know the basics, you can get a pretty good idea of what we're going to be looking at. So if I take one line and I try and put it anywhere on this chart, the only place I could probably put a line at would be right about in that range there, to where the pricing has touched it the most in the entire history. So going back from when this bond particularly started, which was 2003 timeframe, all the way to 2023, or for the last 20 years, I really can't put that anywhere where it's going to touch as many times as it's touching right there. You've got one, two, three, four, who knows how many it is in those little clusters right there. But the point is, you can't put it anywhere else. So this is going to be called what is a level of support. Now, before it can be a support level, it's usually going to be a ceiling. So if we zoom in here, it tested here once, got rejected, tried to get up again, didn't get over it, got rejected, fell, got rejected, came up, fell down, and then tried to come up again. And now that it got past it again, and this was the highest high it's ever been at, notice how it's higher than these guys. Well, sure enough, that's when it came down and started trying to use it as a support. Nonetheless, if we go over a little bit further, hit it, bounce, go up, bounce, 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 and it's been acting as that support level. And then we go for a really large rally and we get up all the way here. And this is when we had some of our lowest rates in 2020. And then here was the big part that kind of really changed what direction we're going to be going. Notice when we came back down again, we fell and we got under it. So we fell, tried to get over once, rejected twice, and then three, and then four. Now, the more times that you get rejected when you're trying to climb a ceiling or get above a ceiling, the higher probability is you're not going to probably do it in this particular round. The more times that you hit a support level, like right here, and you don't fall below it, there's a higher probability that you're actually going to have a little bit more of a rally on the upswing. So basically, think of it as anytime you're trying to hit whatever that boundary is, if you don't break through it, doesn't mean it's going to get weaker. When you hit it the next time, it actually gets stronger, ironically. So the easiest way to understand what mortgage pricing is doing is what is the what direction do the candles go, and how does that correlate to pricing? So long story short, as this goes down, interest rates get worse. As this goes up, interest rates get better. So if we get into the conversation of, let's get this down to the daily count again. If we get into the conversation of, okay, we talked in sometime at the end of January or the very beginning of February, well, interest rates were much better here because the price for the bond was all the way up here. However, since February 2nd and the 3rd and the 4th and the 5th and so on and so forth, it's been declining and getting worse. Now, that's what makes mortgage prices or mortgage interest rates get worse over time versus better. Now, if it decides to turn around and goes back up and goes up here, then interest rates will get better. In a 30-day escrow period to close a transaction, now this is only from December 28th to the high was January 18th. So we're only talking 20 days there. So it's not impossible to do it in the middle of an escrow. It's just unlikely, and you don't want to bet on it. But the point is that any rates that we would discuss, in the past couple of days, unfortunately, they've gotten worse, and so they're not that same rate anymore. The biggest piece of this here that is actually relatively important, this is kind of the stuff that I like to watch for. It's mainly the reason why I get in here so early, is I like to look at pre-market data to kind of see where we're at. But here's what I'm looking at more so than anything else. So when we came down and we hit this low, and we came back up, this was a sell-off point right here, and it touched the Fibonacci level, which I'll explain what that actually means here in a second. But you'll see where it kind of comes down and it almost lands right there on that line. Now, if we come over here to the current day, this was on January 10th. Here's the current day of February 10th. And what I want you to look at is up here where it says O, H, L, and C. That's open, high, low, and close. I want you to pay attention to the L when I put it on this candle. It comes in at 103.12. And if I go over to this candle, it is at 103.50. So with this low, it's only decimals that we're talking as a difference here if we really look at it. Minus 103.12. So it was only off by 38 basis points. Very tiny that most people would think. Here's the reality. When we get into trading in the sense of mortgage bonds or commodity securities, it doesn't matter really what it is, that little tiny difference is an inclination or a probability higher that it's actually going to sell off and get worse, even though it was only a little bit less. And the reason why, there's a lot of bots and computers in trading, regardless of whatever the asset class is, and they look for those little tiny breadcrumbs. And when they see that, then they see, oh, there's still more appetite to the downside, and there's not an appetite up to the upside. So if you ask my opinion, do I think rates are going to be better on Monday or Tuesday? No, they could probably actually be worse. We get into a couple other indicators that are on this chart as well. I know there's a bunch of lines everywhere, but there's two other pieces that we're looking at. So this is your price action in general. At the top here is going to be your RSI, it's your relative strength index. Long story short, think of it in the sense of price confidence. When we're at the middle level here, no one really knows, is this the right time to get it, buy it, or is this the wrong time to buy it? Everyone's kind of indecisive. So it doesn't have to be finances here. Think about it in the sense of, maybe you decide that you want to go ahead and buy the brand new toy that came out for Christmas that everyone's trying to get, right? Probably the wrong time to buy it because everyone's going to be paying the most amount of money for it because they all want it for Christmas. And if you wait 30 days later after Christmas, it's probably going to be a lot cheaper. Point is that when we get up in here and we look at this particular indicator, everyone here is a little indecisive. However, the trend is starting to turn towards the downside and go towards the bottom, which means once it gets here, at that point, there's really no confidence in the actual asset or the financial asset class that it is. And most people won't buy. This is usually what causes a sell-off, but this is also the time when it gets to that low point, like right here, that's the time you could buy and then ride that rally up. I'm getting off the point here, but the reality is that confidence isn't there. The last one is going to be here at the bottom. This is going to be your divergence and convergence. What this translates to is basically momentum. As your momentum is going, if you're going downhill and you got momentum behind you, great. If you're going uphill and your car runs out of gas, it's not going to be a good equation because the car's going to come to a stop. So you're going to notice is that when we get up to this high point here, we lose momentum and then we fall down. And then down here, we start to get the momentum to go back up. And then you can see it do that repeatedly over and over. Now watch, this actually has a little bit of a correlation here. Let's go. And let's get, where's RSI? Index, thank you. Okay. And one more. So here's what I want you to look at when you look at this as a whole. It's always a common thing said in trading, when in doubt, zoom out. So notice up here, oops, that's not what I wanted. So when we crossed, right, crossed at the peak, what happened? Price got worse. At the bottom here, we crossed. What happened? Price got better. We crossed here. What happened? Price gets worse. And then we cross here. What happens? Price gets better. Get up to here. We cross. What happens? Price declines. We cross down here. Price gets better. And you're going to notice it keeps on doing that over and over and over again. So when we get into the current day, well, we crossed here. And what happened? Price got worse. And then we crossed here again right there, and now price is getting worse. So that's what tells me that rates are probably not going to get better, next week in the short-term future. You're going to also notice the same thing as where these points kind of cross and change the direction. Well, notice when we were up here at the highest point, we were at the highest time for pricing. People were just jumping all in, buying as much as they could. and then went to the downside, and people now are buying it or not buying it, and they're selling it because they're not sure about if it's the right move to do. So again, when this got low here, it matches the low here, it matches the low here. That's why you use them in combination. It's not a definitive answer in the sense that it's 100% accurate, but it gives you the idea of, okay, let's do this as process of elimination. One says yes, two says yes, three says yes, but four and five say no. I've got three yeses, I've got two nos. Probability is higher of a yes, right? If you have the winning majority. My point is, if all three of these are in alignment, it's going to give you a pretty good idea of what direction we're going to be going. Now, the other big part here that we're going to play or put into this equation is the Fibonacci equation. Have a good night. The reason why the Fibonacci equation is so important is it essentially will kind of show you where history is going to go over and over and over and over again. So here's what I mean by that. So I'm going to put this at the week as well. Now this is the Dow Industrial Average. This is all the history of of the largest, one of the largest items you can actually get into the stock market per se if you want to do investments wise. Let me go back a little bit on a month so I can get the whole thing to fit. There we go. Okay. So going back all the way to 1897. On the left-hand side of the screen here, this is the Great Depression. So follow the math equation here for a second. 1 plus 1 is 2. What comes after 1? 2. And 1 plus 2 is 3. What comes after 2? 3. That equation infinitely sums just like pi does. Essentially, it never ends, as the numbers will always go in sequence and add and sum together. Here's my point. If you measure the highest point of your rally to the lowest point of your rally, that's going to give you your 100th measurement and your 0 measurement. And I'm going to take this off because I've got it reversed right now. Where is, oh, there it is. Okay. So by measuring our peak and measuring our valley, that will tell us when our next peak is, and that will tell us when our next valley is. And so, mind you, this is the Great Depression. I'm measuring this back in 1920s, 1925, 30s. All I'm going to do is just let this line run all the way over to the right. And sure enough, it predicts 100 years of history. And here we go. We come up to our ceiling and we'll get over that one. And then we come up to this ceiling and had a little struggle, try to get over it and fell under, and then try to get over it. And you can see we kind of trade sideways here for a little bit. But notice how the price action literally falls directly in correlation of where the Fibonacci math shows the next point of contention is going to be. Well, if we look at where we're at the current day, and we get right here, I drew that line in the 20s and the 30s. Here we are in the 2020s of this day and age, and I couldn't put the line closer if I tried. I mean, it's literally falling right on it as if you drew it there purposely. And that's just the math behind the equation. Here's my point, or I'm getting to. The Feds want inflation at 2%. We're still in the sixes. We're nowhere close. You have a lot of rejection right now currently in the stock market. And the bond market, which is even larger and bigger than the stock market, is having a ton of difficulty of trying to get above some of these lines. And the reason there's so many is you're not really supposed to go back and measure 100 years ago and actually see what it does for the rest of the future. Every time you have a peak and valley, you're supposed to actually measure it. So the correct way to do this is you do the one where you start your price action at, and then I would do one here. And then I would come up here and I would do the same thing for when it happened in 2020. And I'm going to make this one a different color so we can see it nice and easily. Now notice the one that we just drew, that's the most accurate one, same thing's happening. We come up, we touch the lines perfectly, and then we fall right onto the support, and we keep touching the lines, and now we're stuck right at that line on the dot. And again, this is just the math of it. So in summary, where do I think the rates are going to be going? I think they're going to get worse still in the initial short-term future until we get inflation under control and until we really see this trend change. Last thing I'll show you is this aspect of it here. Whatever your overall trend is in general, is going to probably depict what your trend's going to be in the future, meaning that what direction you're going to be seeing, in the next 30 days. Well, since 2020, we've been going down, and we haven't been able to get back up the other direction. So with all that momentum of the sell-off currently, there's a very good chance that we go lower, right? And how low would be the question? Well, my estimate is somewhere right around here. And we haven't been there we've never been there actually in this bond, and we're getting to the end of this bond. But my point is, if we put all my million colors and lines back on this, and we go into the current day, you're going to notice I have these two little letters right here, just kind of, you see the rest of the letters. And this is my indicator of where I think we're going to have to hit at this point before we're going to be done. I hope I'm wrong, but the reality is, your initial question was why did the rate change from a couple days ago? Unfortunately, pricing's changed because the market's just getting worse and it's having a sell off. And it's highly advised that we lock when we can. First step to do that is getting the income documentation. So hope this makes sense. If it doesn't, call me on my cell, 702-421-1111. Talk to you later.